Welcome and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. Headquartered in Fort Worth, Texas, we work with accounting firms across the country to deliver expert guidance in areas such as the R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have a question specifically for our presenter, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, a PDF of today's presentation is available for download now, should you wish to follow along or reference it afterwards. With that, let's get started. I'm pleased to introduce our speaker today, who is Imran Syed. Imran joined Source Advisors in 2010 and is currently the Managing Director of Energy Services. Imran is a mechanical engineer by trade and has more than 15 years experience in sustainability and energy efficient buildings. He is a registered professional engineer, a certified energy member, a lead AP, a HERS rater, an NGBS verifier, and Energy Star partner. And with that, I will hand it over to Imran.
Thank you, Anne. Morning, everyone. Welcome. Over the next 45-50 minutes, we'll go through certain energy tax incentives, highlight certain changes that happen because of the One Big Beautiful Bill, and then go over and discuss certain practical insights and what this actually means to your clients. Before I go through the agenda and all of the additional slides, I do want to mention, please do send your questions through the Q&A tab. I will certainly take them as we go through the presentation, and I'll probably leave about 5 or 10 minutes at the end of the presentation to respond to all of your questions. So to begin with, we'll discuss Section 179D and 45L, which is the commercial and the residential tax credits and deductions. The impact that the Big Beautiful Bill had on certain renewable energy systems, namely solar and wind, and then also go over certain aspects of monetizing some of these tax credits. No, all right, there you go. Let's start with the polling question.
All right. Which of the following studies have you recommended to clients in the past? A is Section 179D, Commercial Building Tax Deduction. B is Section 45L, Residential Tax Credit. C is Investment and Production Tax Credits. And D, all the above. Please make certain that your brightness is up all the way. Sometimes it's hard to see how to respond to the polling questions, and that's usually the issue. And again, you need to respond to 3 of 4 polling questions and stay on the call for 50 minutes in order to receive CPE. Looks like we have got a majority of responses, and it's equally divided between Section 179D and all the above.
All right. That should be a good audience for me then. Let's get started with 179D. And my goal during the presentation is not to go into all of the details of certain tax incentives, but rather focus on what changed and what are the sunset dates to make sure that all of our clients can maximize those tax incentives. But I'll briefly go over Section 179D. It's a tax deduction that caters to commercial and residential properties. Commercial buildings of all sizes, of all stories can qualify. As for residential projects, they do have to be 4 stories or higher in order to be eligible for the tax deduction. With commercial building owners, as long as these are new construction, major renovation projects that deal with HVAC, lighting, building envelope, that project should be eligible for a tax deduction. The other vertical under 17090 is for design firms. For projects that are government owned or starting from 2023, non for profit owned properties, since these are tax exempt and cannot take the 179D deduction, what they can do is allocate that back to the architectural engineering firm, in some cases, controls contractors as well. Design build firms can also be eligible to take the tax deduction. And the primary rule that the IRS looks at is the fact that these firms should have design specifications for the project. Merely installing, which most general contractors and subcontractors might be doing, would not be enough to be eligible for Section 179D. There's a certain set of rules pre-Inflation Reduction Act. Surprisingly, we're still talking about the IRA, although there's the big beautiful bill that's come up, but the rules have not drastically changed under the big beautiful bill. So a lot of the IRA regulations still apply. So pre-IRA, the deduction used to be $1.80 per square foot, with the ability to qualify the individual systems, whether it's the lighting or the HVAC or the building envelope, individually as well. And that was about 60 cents per square foot. That still remains in place. Now, obviously, with the 3-year statute of limitation, it wouldn't really apply for design firms anymore. But for commercial building owners, they can absolutely go back as far back as '06 if they truly do see any value in doing so, and take that tax deduction. Therefore, the deduction amounts listed here are still applicable for commercial building owners. As you all probably already know, Form 3115 has to be used in order to use a 179D deduction on a prior year project. With the Inflation Reduction Act, two things happened with 179D. One, the deduction that used to be $1.80 per square foot increased to up to $5 per square foot. Now, this depends on two aspects of the project: the energy savings, which at 25% savings, that tax deduction could be 50 cents per square foot. At $1 or at 50% savings based on the energy efficiency, that deduction goes up to $1 per square foot. And there's a range between 25 to 50% where that deduction can be anywhere between 50 cents to $1 per square foot. Now, that's the base deduction. And clearly the values are slightly different because of the inflation adjustment. Now, the bonus tax deduction for 179D on the same project depends on two aspects. One, if the construction of the project began prior to January 29th, 2023, that project is automatically eligible for $2.50 to $5 per square foot for the same energy savings. Now, that's in a way you're grandfathering that project under the old rules. The other thing is, if a project begins construction after the 29th of January 2023, which are probably most of our projects that we are currently working on, then you are eligible for the base deduction of 50 cents to $1. But for the project to be eligible for the higher deduction range, 5 times multiplier, the project has to meet both the prevailing wages and the apprenticeship requirements. We'll discuss a little bit about what PWA requirements meet, but that's going to be a critical piece in order to get the higher tax deduction. With the big beautiful bill, Section 179D, which was actually a permanent part of the tax code, does sunset for projects that begin construction after June 30th of 2026. So we've got a couple more months left. The key piece to this is it's the construction start date. So for all intents and purposes, with our clients who are right on the fence of starting construction or about to begin work of physical nature, this is a good reason why construction should and can begin prior to the end of June in order to be eligible for the 179D tax deduction. Any project that starts construction after that date will not be eligible for 179D. There's always a chance, and we've all seen this happen over the last decade or so, where 179D does expire and then retroactively gets extended. We do expect that to happen at some point, but until then, these are the rules that we will abide by. We'll go through a few case studies. This is one that was placed in service after the Inflation Reduction Act passed. It's a relatively smaller project, 19,000 square feet, government owned, and therefore the design firm gets the tax deduction. The savings that we achieve was about 54.1%, so it's above the 50% criteria, and therefore is eligible for the maximum tax deduction of $5.36 per square foot with the inflation adjustment applied to it. And that resulted in about $101,000 in tax deduction. Two things that really helped with the project. One, the construction start date, which is prior to the 29th of January 2023 date. And therefore, even though the project meets the PWA requirements, it was a government project, was required to meet PWA, we could have easily used that methodology to get the maximum reduction, but we didn't have to go through any of the tax forms for that since the construction already began prior to that date. I will say something before I go into this slide. Section 179D, 45L, and a lot of the ITC and PTC projects, starting from 2026, there was a new form that was released by the IRS called Form 7220. It does require documenting all of the prevailing wages paid to the contractors and subcontractors. And Part 3 of the Form 7220 goes over documenting the number of apprentices. And there's obviously the good faith exemption that can be applied in some cases. But that form is a mandatory requirement whenever you're taking the higher tax benefit based on the PWA compliance. Merely stating that the PWA requirements were met would not be enough. Form 7220 has to be submitted with every tax deduction credit wherever the PWA requirements must be met. With that, moving on to Section 45L, which is the counterpart to Section 179D, applies to all residential properties. Prior to 2023, these were limited to 3 stories or less. You could have single-family homes, townhomes, duplexes, all of them were eligible for 45L prior to 2023. And this was a relatively straightforward qualification criteria. Starting from 2023, and this occurred because of the Inflation Reduction Act, the qualifying criteria was changed to Energy Star certification or the Zero Energy certification. Depending on the certification, the tax credit amount was higher. But the positive that came out of the Inflation Reduction Act was there were no limitation on the number of stories, and therefore, if it was a mid-rise or a high-rise residential project, it was still eligible for the 45L tax credit. The amounts varied from $500 all the way through $5,000 per dwelling unit, depending on the certification that the project was pursuing, or depending on whether a multifamily project met the prevailing wage requirements or not. Prevailing wages were not a requirement for single-family homes, duplexes, and townhomes, which happened to be a majority of the projects that we ended up certifying between 23 and currently until middle of 2026. Similar to the sunset date for 179D, 45L sunsets for dwelling units that are leased or sold after June 30th, 2026. The difference between the sunset dates for 179D and 45L is the terminology. With 179D, it's the start of construction date, meaning that project could get completed in 27 or 28 or 29, as long as the project started construction, work of physical nature began, or there was a binding agreement in place before the 30th of June. that project is still eligible. 45L, however, the project must be completed. It must be certified under Energy Star or Zero Energy Ready, and there must be a leasing or a sale agreement in place after the 30 or by the 30th of June. Occupancy isn't a requirement, but an agreement for leasing or sale of the unit must be done prior to that sunset date. Here's a case study for a multi-family project that certified under Energy Star and the Zero Energy certification. It was actually an affordable housing project, and therefore the client was required to meet the Davis-Bacon prevailing wage requirements, which made it easier for a multifamily project to qualify for $5,000 per unit, 144 units. All of this got completed a couple of years back, and the tax credit was about $720,000 in total. Similarly, on a single family project, smaller subdivision, 20 homes, the construction began right after the Inflation Reduction Act was passed. We were able to come in, help out the builder with changing the design to make it to qualify under the Zero Energy certification. Uh, and this is a single family builder, so we didn't have to do any of the prevailing wages for this one. And that resulted in about $100,000 in tax credit. I will say this, since the Big Beautiful Bill and the sunset date, we've stopped looking at multifamily projects, especially if they haven't started or if we feel like they won't be completed by the end of June 2026. Single family homes have been the most project that we've been certifying in the last couple of months. And for clients like those, again, the goal is to make sure that those homes actually do get completed, get a certificate of occupancy in place, and actually lease or sell this unit before the end of June. Okay. This is again just a summary about both the 179D and the 45L and the impact that the Big Beautiful Bill had on both of them. As I mentioned, there is that June 30th deadline. So if you have clients who may be unaware of the deadline or who's planning on starting construction, especially on the 179D front, now might be the time to inform them about it. All right. Let's go to the next polling question.
Okay, which building does not qualify for 179D commercial building tax deduction? A is auto dealership, B is public school, C is single family home, and D is none of the above.
It's a 179D tax deduction. So residential properties that are less than 3 stories are not eligible for 179D.
I think we're all set.
All right. Thank you. So on that same note, I just want to cover a few things. 179D, as I mentioned earlier, does apply for all commercial building properties, whether it's a auto dealership, a manufacturing facility, a warehouse, public schools, colleges, universities. All of these are eligible properties under Section 179D. There is a question, and I do want to answer that before I go into the next slide, which is, and I'm going to cover this in more specifics in a little bit, but what does beginning of construction truly mean? How do I make sure that work of physical nature has started? And the IRS has provided enough guidance regarding this. There was some gray area in the beginning, but it looks like some of the guidance that came about a few months back does clear up quite a bit. And do note, a lot of the guidance that we have about beginning of construction isn't truly specific to 179D or truly specific to 45L. it actually falls under the Section 48 investment tax credit. So those rules, in a way, also apply towards 179D. But the general ruling that the IRS provides is when you look at work of physical nature, it has to do with the eligible property itself. And therefore, certain preliminary work that's being done on the site, site clearing is a good example, that wouldn't really be eligible towards that construction test. And so does a lot of the preliminary work with regards to utilities and so on and so forth. So there are things that we do need to pay attention to with regards to what exactly does it mean. But in a general sense, it talks about construction with respect to the eligible system. I keep saying the term eligible system because the system can only be a solar panel system that you're taking a tax credit for. In that case, work of significant nature or physical nature is related to the solar panels themselves. And so there's no blanket response to a question regarding beginning of construction, but we do need to look at something more substantive with regards to the property itself. Now, before I go into the investment and the production tax rate, I wanted to take a moment to go over the low income housing tax credit. And there's two types of credits for that. One is the 4% non-comparative, and then there's the 9% LIHTC deal. Most housing agencies have certain requirements, whether it's a 4% deal or a 9% deal, for those projects to meet certain energy efficiency standards. And these are in forms of a third-party certification. These can be National Green Building Standard certification, Energy Star, Enterprise Green Communities, passive housing, and these are all again dictated by the local housing agencies. The reason I bring this up on the CPA presentation is the Big Beautiful Bill enhances certain provisions under the low income housing tax credit deals. For 4% credits, that bond threshold that used to be about 50% has been reduced to 25%. So there is certainly things that the Big Beautiful Bill brings to the LIHTC projects which help. Also, there are additional basis boosts or bonuses for projects that are in a rural, tribal, or an opportunity zone. Again, all of this has certainly change or transition the market for a lot of market rate builders to look into affordable housing because of the low income housing tax credit deal. The other aspect to LIHTC project is all of these deductions and energy tax credits that we will be discussing in the next few slides. All of them are being used towards the capital stack for LIHTC projects, and therefore, even though we may not be working directly on a LIHTC project, obviously we do help out with the energy certifications, but knowing that a lot of the investment and the production tax credits and Section 179D or 45L, all of that certainly helps towards the capital stack for LIHTC projects. All right. So we'll go into the investment and the production tax credits, and they've been part of our tax code for a long time. Things have changed for or under the Inflation Reduction Act. A lot of these investment and production tax credits were expanded and extended for at least a 10-year period in most cases. A lot of that still stays as is, but with the Big Beautiful Bill, the most impact that it has is on the solar and the wind projects. And I will say nothing positive. Most of them have been quite negative to both the industries, and there are some stringent placed in service deadlines and some sunset dates that we all need to pay a little more attention to. And again, this is a one pager in a way that summarizes, depending on the construction start date, what are the rules and the regulations for solar and wind projects. I'll focus on the last four rows because 2025 and all of 2020 or all of 2025 is past us. For projects that began construction prior to 2026, those projects are under the old regulations, and therefore nothing really changes. There's no impact of the Big Beautiful Bill on projects that began construction prior to 2026. Now that leaves us with two timelines. For projects that start construction between January 1, 2026, all the way through 4th of July this year, those projects are eligible under Section 48 or 45, depending on whether they're doing the investment or the production tax credit. They do have 4 years for the project to get completed and placed in service. So you do have that continuity safe harbor. You have the time to get the project completed. However, for all projects that start construction in 2026 and moving forward, they do have to meet what's called the FEOC, or the Foreign Entities of Concern restrictions. And I'll go into some of the details in a little bit. For projects, and this is the second timeline to remember, that start construction after the 4th of July, the 4-year continuity safe harbor is eliminated. The project must be placed in service by the end of 2027. So you only have a year and a half to get the project completed. For small scale projects, that may not be a big issue. For large scale utility projects, certainly they need a few more years to get the project done. And therefore, the practical aspect to this is most projects, and these are conversations that we've been having since the Big Beautiful Bill passed, and we do continue to have until at least end of May or end of June, which is trying to grandfather or start the project before the 4th of July. So at least at the minimum, you've got that 4-year window to finish the project. Now, whether the project starts prior to the 4th of July or after the 4th of July, irrespective, the FEOC restrictions will apply, which means there are a few more calculations and there's a few things that needs to be shown compliance with that must be done. You can't get away from that aspect of it. Section 48 for solar and wind projects, I want to be specific, but 48 can apply for other energy properties as well. But for solar and wind, does expire after 2027. So starting from 2028, there is no tax credit for solar and wind projects. As far as beginning of construction tests, for both these eligible properties, if a project is less than 1.5 megawatt, which 1.5 megawatt is a big size project, and most commercial projects are probably going to be less than that, you are allowed to look at both the physical work test, which I mentioned a little bit about, work of physical nature, or you are allowed to use the 5% safe harbor rule, which is if 5% of the total cost of the project was incurred before, and in this case, let's say before the 4th of July, the project is considered to have started construction prior to the 4th of July. The same rule was used to start projects before the end of 2026. So all the way through December of 2025, clients were looking at the capacity of the project. And if it was less than 1.5 megawatt, they were putting in a signed agreement in place and they were paying a little more than 5% of the overall cost. And then obviously there needs to be a continuity safe harbor that applies as well. For large scale projects, that's more than 1.5 megawatt, you cannot use the 5% safe harbor rule. Physical work test is the only test that will apply. And that means there needs to be a little bit of consultation with regards to how do we prove that work of some nature actually started, and that is applicable towards the eligible property. A couple more things. One, the Inflation Reduction Act does bring in options to monetize a lot of the investment and production tax credits through your elective or direct pay and the transferability option. And this is not a cost seg CPE by any means, but the same rules that apply for cost seg studies regarding the 100% bonus depreciation also applies to eligible energy property. Okay. I intended to have the font a little bigger on this one, but bear with me as I go through this. And this, again, I'm just going to briefly touch upon this. And this, as I mentioned, the BOC at the beginning of construction rules apply for most tax incentives, especially with the sunset date. But the rules are set namely for Section 48 and or 45 tax incentives. We have talked about the physical work test, but one of the things to remember is the IRS does allow any offsite physical work to be eligible as proof of construction or proof of physical work. And I'll give you a few examples. We've seen certain projects where a transformer had to be installed or designed for a specific project, and that transformer was a requirement and an integral part of the battery storage system. That transformer had to be manufactured to the exact specifics at an offsite location at a plant elsewhere. And that can be shown as work of physical nature, especially if you're depending on that test. Similarly, with a lot of modular construction that happens lately, that can also be shown as proof for physical work. So it can be both on-site and off-site. As I mentioned previously, certain preliminary activities do not qualify, and therefore it is critical that we know what that is and make sure that we're not using that towards proving physical work test. With the 5% safe harbor, again, I've mentioned this is based on the invoices or the payments incurred by the taxpayer. I actually had a question this morning about whether an invoice from a subcontractor or from the EPC manufacturer is sufficient. And in most cases, just getting an invoice does not mean, and usual accounting methods as well, may not mean that the costs were incurred by the taxpayer yet. So I do recommend that a payment actually be made in order to prove the 5% safe harbor. When you calculate the 5% safe harbor relative to the overall basis, the general ruling is that any cost that is depreciable or part of the depreciable basis is part of the overall 5% calculation. And therefore, land costs are generally not included when we make those calculations. All right. I added the slide mainly to showcase certain scenarios that might apply to you or your clients. And I've tried to cover as many of these as possible, but I'm not going to go through all of them. But the takeaway from the slide is the capacity, let's say on a solar project, the capacity does impact what tests are used, and therefore if it's more than 1.5 megawatt, you do want to show a work of significant nature, including if it's steel racking or including any support that the solar panels may need. All of that can be part of the calculations themselves. I do want to focus your attention to the bottom part of the slide in red. So here's an example, and these are all scenarios that we've run into, and we've tried to summarize this. But there was one client, again, the project exceeded the 1.5 megawatt capacity. Clearly, the 5% safe harbor rule could not be met, and work of physical nature had not started prior to 2026. That was the goal of the client, is to avoid all of the foreign entities of concern restrictions, and try to start work before that. And we'd advise them about not able to use the 5% safe harbor rule. So this is what we had to provide the taxpayer, the client, with, is three possibilities. Um, the first one obviously couldn't be done because work of physical nature couldn't start last year, which leaves them with two options: get the work started prior to the 4th of July. And even though you do have to meet the FIOC restrictions, you do have the 4-year period to get the work done. Or for some reason, if work of physical nature isn't starting and there may be some issues with inventory and there may be some issues with material and delays and so on and so forth, if it does start after the 4th of July, uh, remember to get the project completed by the end of 2027. And therefore, you will probably run into a lot of these scenarios as Section 48 solar and wind sunsets in the next couple of months. Right? When we look at solar projects, most of us probably are thinking about commercial building clients, for-profit clients using the tax credit, which is 30% base, and there's bonus for energy property, or a 10% bonus if it's in a low-income area. There's an additional 10% when there is domestic content, U.S. manufactured products involved. But thankfully, with the Inflation Reduction Act, we've run into numerous projects that took advantage of the Section 48, but were school districts or non-for-profit entities. And this is one of them, again, a school district in Michigan. And they were installing solar panels on various projects. And most of them were less than a megawatt and therefore did not have to meet the prevailing wage and the apprenticeship requirements. But here's a good example. This is, one project, a high school, 1.4 million in total solar panels, and you can see the volume of solar panels that they've installed. Got the 30% base credit, gets the 10% low-income community bonus, which is an application-based tax credit that needs to be applied for. And so a little over $500,000 in tax credits. And the question is, well, it's a school district. What are they going to do with the tax credit? And we'll touch upon that in a bit. But they're able to monetize that using the elective pay option. And what that process looks like, we will cover that in a bit. Here's another example. And instead of the solar panels, this school installed geothermal for their heating and cooling needs. And it was less than a megawatt, again, overall capacity. About 1.5 million in tax in cost basis. This obviously was eligible for the 30% base. It was in an energy community. It was under a census tract, so it automatically got a 10% bonus tax credit. And since it's a geothermal system, and unlike solar panels, majority of the geothermal systems are manufactured in the US and always are eligible for the 10% domestic content bonus. So that resulted in a total of 50% in tax credits for the school district. And they had to go through the elective pay option also to get a refund check back from the federal government. All right, let's take a polling question. This is the third out of 4 polling questions.
Yes, beginning in 2026, does Foreign Entity of Concern, FEOC, restrictions affect eligibility for certain investment and production tax credits? This is our third of 4 polling questions. And it looks like the majority says A, yes.
Yep. And that is correct. Yeah, FEOC, and I'll go into what FEOC actually means, does have an impact on both the investment and on certain investment and production tax. And it's a big deal, especially for projects that start construction in 2026. I do want to take one question before I go into the production tax credits. It's about whether a new hotel project located on a reservation be eligible for either 179D or 45L. It's a hotel building, and that's not, for building code purposes, isn't regarded as a residential property. It's a commercial building, and therefore it is eligible for the 179D tax deduction, not the 45L tax credit. Now, however, and I'm assuming it's on a reservation, so it's probably owned um, by tribal organizations. And if that is the case, tribal organizations, because of their tax exempt nature, cannot take the 179D deduction for themselves, but they can allocate the 179D deduction to the architectural or the design or the MEP firm. So the deduction can be not transferred, but can be provided to the design firms. And this happened because of the Inflation Reduction Act. Prior to the IRA, government projects were the only ones that the design firms were eligible to take the deduction on. Starting from 2023, other tax exempt entities are allowed to allocate that deduction as well. All right. Moving into the production tax credits, and one of the major difference between an investment and a production tax credit is the timing of it. With the ITC, whether it's the 30% base credit or the bonus credits included in it, you take the tax credit for the tax year when the project is placed in service. It's a one-time tax credit based on the cost of the project or based on the eligible basis. Production tax credit, in most cases, is a tax credit that is an annual credit depending on the production of the eligible property. It can be clean hydrogen, for instance, or it can be manufacturing of certain eligible components in the US related to solar or batteries or wind. It can also be related to the amount of electricity being generated by solar panels on an annual basis. Generally, it's about a 10-year period. For carbon sequestration, which is the carbon capture tax credit, there is a 12-year period for which you can avail the tax credit for. So it's the timing of taking the tax credit, as well as, instead of looking at the eligible basis, the production tax credit focuses on what's being generated on an annual basis, which means there needs to be certain documentation that is done, whether it's quarterly, half yearly, or annually. But before you file tax returns and use a PTC, a lot of that documentation needs to be in place. And there's a lot of moving parts with each of these tax credits. And that's the reason I'm trying not to generalize, because all of these 7 production tax credits, and by the way, 45 is almost the same as 45Y with some additional requirements. But all of them have certain nuances with the sunset dates in some cases, or certain requirements with regards to PWA, and even the tax credit amount is different for each of these eligible production tax credits. Right. A couple more things to remember as we go through some of the production tax credits. Geothermal heat pumps, especially that's non-electricity generation, used for heating and cooling. And if you are running into projects which are thinking about installing geothermal, one of the good things with both the IRA and the OBB was that they have been expanded, and they are eligible under the legacy rules as long as construction begins by the end of 2034. There's a long period before which you can utilize that tax credit. Just as a quick review, geothermal is eligible for 30% base, depending on, again, the capacity of the geothermal system. But it is also, as I mentioned earlier, the 10% domestic content is not a far stretch. It's almost every geothermal project we've done comes with a base of about 40% tax credit. Same thing with other eligible Section 48 tax credits. Everyone thinks about just solar under Section 48, but there's fuel cells, there's methane, there is combined heat and power. There's a lot of other eligible properties under Section 48E or 45Y for that matter. And one of the things to remember is starting from, I think this was starting from last year, there is a requirement to show net zero greenhouse gas emissions, and therefore there's a little bit more calculations that must be done. Right. Again, a few more notes on some of the other tax credits and the impact that the Big Beautiful Bill had. What I've tried to do here is provide certain sunset dates, and I'm not going to go through each one of them, but it does clearly mention when these tax credits are expiring, or in some cases, when the phase out begins. I briefly went over the elective pay option, and I'm going to touch upon that a bit more. But one of the impacts that the Big Beautiful Bill has on the elective pay option is there is no elective pay if projects are tied to foreign entities of concern. And those are the four countries, China, Russia, North Korea, and Iran. Those are PFEs, or prohibited foreign entities or governments that are part of the FIOC rules, and this does require some calculations and a lot of documentation with regards to where a lot of the materials are being produced from. The good news is this has had a lot of positive impact with a lot of manufacturing happening within the US for a lot of these eligible systems. The calculation for FIOC, and this is something that every project that falls under the FIOC rules, starting from 2026, must go through in order to show eligibility. This is not a matter of whether a 30% credit goes down to 6% because we didn't meet the FIOC rules. It's a matter of even being eligible for the tax credit, and projects will get disqualified if the FIOC rules are not met. And in a nutshell, what this is basically saying is when you look at the material assistance cost ratio, which is, and the formula is shown there, which is basically the amount of cost for materials that are produced by a prohibited foreign entity, as long as that's less than 40% for projects that start construction in 2026. That criteria does move up to 45% in 2027, but for 40%, as long as it's less than 40%, it is eligible for the tax credit that you're looking into. At any point, if that percentage of maker exceeds that criteria, the entire project becomes ineligible, and therefore this calculation must be done prior to clients signing off with their EPCs or signing off contracts with their subcontractors and general contractors on projects like these. This is again a critical piece of all projects that start construction in 2026. We have, and we obviously do a lot of consulting on this. A lot of the time, especially during the proposal phase, when we are talking to suppliers, we are asking for certain certifications and certain documentation to prove that none of their material is being manufactured from certain prohibited foreign entities. We've covered a lot about the investment and the production tax credits, and in a lot of cases, that tax credit is being used towards taxable income. But with the Inflation Reduction Act and the fact that it allows for monetizing some of these tax credits, we are able to do one of two things. For most non-for-profit state local government organizations, elective payment method or the direct payment method is something that they are able to use to actually get a refund check back from the federal government. And that does require what's called a pre-filing registration process. And I'll go through that in a bit. For-profit entities uh, that are either using the Section 48 investment tax credit or the Section 45 production tax credit, they do have the option of selling the tax credit in a marketplace. Um, the marketplace entities generally help with finding buyers, in some cases sellers, insurance for the transferability option, as well as they are able to use reports from third-party certifications, such as us, to validate and make sure that both the eligibility requirements, the FIOC restrictions, the prevailing wage and apprentice requirements, and the calculation of the credits have been done in accordance with the rules before they go in and start finding buyers for our clients. So the transferability option has been of great value, especially for our clients as they try to monetize on some of these tax credits. Um, I will note there's been a lot of times where a lot of our production tax credit clients have been able to come up with a contract with the buyer to not just wait for the whole year in order to get the tax credit, but on a quarterly basis are able to provide capital and are able to sell the credits in the marketplace in order to get some capital flowing as they go through the production work. Now, whether it's the elective pay option or whether you're thinking about transferring the tax credit, the IRS requires that eligible property to go through the pre-filing registration process. There's an IRS portal that must be used, and it's we've done this enough times where the process is fairly straightforward. It does have certain technical questions that are asked, but that pre-filing registration must be completed before the annual tax returns are due. The IRS recommends at least 120 days before tax filing deadline. Source advisors recommend that the pre-filing registration start as soon as the project gets placed in service. It certainly helps with getting those registration numbers much sooner. And two, it also gives the client and the tax preparer and the CPA enough time in case the IRS has any specific questions with regards to the pre-filing registration. A lot of the projects we've completed in the last couple of months with the pre-filing registration process, we've seen anywhere from 30 to 45 days to get the registration number, especially if there's no questions asked. If there are certain questions asked by the IRS, it took us about 2.5 to 3 months to actually get the registration number. So the process is actually quite efficient, but it is, just to reiterate, it is an absolute requirement for this to be done. And most non-for-profit entities, and in some cases for-profit entities, might not be aware of this process. All right. This should be the last polling question.
Sorry about that. Starting from 2023, the following entity or entities are eligible for the elective pay option. A is a public school, B is tax-exempt building of worship, C is nonprofit hospital, or D, all the above. Looks like D, all the above, is getting the most answers.
And that is correct. All non-for-profit entities, 501c3s, are eligible to use the elective pay option.
And we're all set.
Awesome. All right. That should be the end of the presentation. I'm going to be here in case there are more questions. And if you have questions after the presentation is done, please do feel free to share an email, send an email, and we'll make sure that we respond to all your questions. And I believe the handouts are available for anyone who would like to download them.
Yes, and we do email both the presentation and the recording about 3 to 5 business days after the presentation as well. I think that's it.
All right. Thank you so much for joining. I know it's never a fun presentation when we're talking about sunset dates, but I hope this is timely, and I hope your clients are able to capitalize on this. Thank you, everyone.